Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Jared Blikre, your host, and with me is Yahoo Finance senior reporter Allie Canal, who's here to connect the dots and to be that bridge between Wall Street and Main Street. Today, we're going to be talking about the U.S. and global economies, and we've got a crack economist to help us do just that. Our phrase of the day, government shutdown. Uncle Sam is dimming the lights once again, but key for you, how does it affect markets? How does it affect your money? And on today's Market Show and Tell, we break down a key indicator of uncertainty in the bond market. Even if you don't own bonds, why you should be paying attention to their message. And this episode is brought to you by the number 14. That's the number of years each Federal Reserve governor is appointed for, a key pillar of Fed independence, which we will dig into with gusto. And today we are welcoming Joe Brusuelas, who is RSM's chief economist. He frequently briefs lawmakers, and he's the mind behind RSM's Real Economy Outlooks. Joe has made some big calls on this podcast this year, and we're going to get some key updates from him given recent developments. So, Joe, we're going to dig into government shutdown in a minute here. What's your big picture view of the U.S. economy?
The U.S. economy appears to be set for a reacceleration. The economic data outside of hiring has looked a little bit better lately, to be honest with you. Right now, the U.S. economy is floating on three things: a strong tailwind from the equity market that's bolstering the spending of upper income consumers. The final thing is the sheer volume of investment in data call centers for AI.
Yes.
And what's going to happen behind that to develop the energy infrastructure is why we think, along with full expensing, tax cuts that are going to impact the economy next year, we're set for a modest reacceleration.
Well, AI and consumer bifurcation, two of the topics that I'm very interested in. But as Jared alluded to, it's time now for our phrase of the day, government shutdown. When Congress misses a funding deadline, parts of the government power down. Essential services keep running, but many others, including key economic data releases, go dark. For markets, that means no jobs report, no CPI, no key updates. So investors lose a major compass until funding returns. And the longer it drags on, the bigger impact on the real economy. So, Joe, walk us through what we should expect the longer this stoppage continues.
All right, so the first thing is that markets and investors have been conditioned not to respond to this. So we really have a 2-week window. Now, there's a reason why. Today's October 1st. Everybody got paid. So if this would linger on through October 15th, or specifically the week of October 12th to the 18th, that's when you'll start to see a more pronounced move across asset markets. The only thing we really see is a little bit of weakness in the dollar, which we always get around the American fiscal policy, right? That always happens. But should this linger, then there'll be a bigger issue. Now, in terms of the real economy, a very modest impact, only 0.1% drag on GDP per week. Now, should it move into sort of 20 to 30 to 40 day shutdown? Well, you'd expect to see a lot more drag, so it could conceivably double. But for now, this is manageable. And remember, the 750,000 or so workers who are going to be furloughed, they'll get back pay. Where this gets a little bit more dangerous is if the Trump administration follows through on its threats to engage in mass hiring, then you'd see a hit to not just corporate confidence, but consumer confidence, and that'll flow through to spending really quickly. But again, we've got 2 weeks. It's when we get into that October 12th to October 15th area, that's when this gets serious.
You know, by understanding of the way the labor market, the Bureau of Labor Statistics collects data, that's also a key window for the jobs report that we will be getting in early November. Hopefully we'll get it on schedule then. So how does this shutdown affect that? And how do you think it affects the numbers that we're supposed to get for September that are supposed to be delivered for this Friday?
All right, so it's an incredibly important point. Let's take the latter part first. Okay, so this one impact anything in terms of the collection. The survey's already been done for the household and the establishment. It's just a matter of time before we get that. And that'll be up to the BLS once the government reopens. My sense is we'll get 2 for 1 the first Friday in November, as long as this is solved by then. However, and this is what's really critical, I'd mentioned that week of October 12th to the 18th.
Yes.
The reference day is going to be the 15th that month. So if they don't get this settled in advance, we won't get an estimate on the unemployment rate for the October period, the first Friday in November. That's why these things typically, they get solved in a few days. We've only had a couple of them that have lasted more than that. But it's an unusual confluence of timing and events. So if they don't get it done, it may be the November report, the first week of December, before we get a clean read on the unemployment rate.
What about inflation, too? Because that is a big part of the Fed's dual mandate. And the inflation report, I think, is due October 15th.
Yeah, that's incredibly important also. I'm a little bit more concerned about the direction of inflation, to be honest with you, than I am employment. And so the Fed's got a much more difficult degree of landing because, believe it or not, the Fed gets a weekly update of the ADP estimate.
Oh, interesting.
They do. Most people don't understand that. So the Fed's not flying blind when it comes to the labor market, right? Inflation's a little bit more difficult. They're probably going to be talking to the MIT Harvard Billion Prices Project. And to get an idea of what's going on, there's a whole host of alternative data that we're all going to be talking about for the next number of years. So they have something to look at. But specifically with CPI and PCE, they need that data.
Yeah.
Right? They really do, because we're at that time where a policy error could be made in terms of why are you guys cutting rates when an economy that looks like it might reaccelerate?
And that's exactly a point that we've been hearing more and more. Apollo chief economist Orson Salk, Apollo, our parent company, said exactly that they were maybe cutting rates at a time when we don't need rate cuts, and that could reignite inflation. So I know the Fed is at a difficult point, a tricky balancing act, but how concerned are you that if we start easing, inflation's going to reaccelerate?
Okay, so for everybody out there, I'm not just shooting from the hip. I run 4 formal, very sophisticated models to estimate the optimal interest rate for the United States. Mm-hmm. Not one of them suggests that we should see any further rate cuts. Not one. And inflation's moving higher, right?
Yeah.
So we're at, is we're going to get a Greenspan-like risk management insurance rate cut because we see negative numbers at ADP. You can see the slowing inside the BLS numbers, right? Okay, that part I get and I can sign on to. But what it doesn't mean is, and this is important, Allie, that we're going to get a full rate cutting cycle. That, the feedback loop, if that were the case, would feed right into asset prices. And then we'd be setting up for what I would call a healthy correction, but a sell-off nevertheless. So from an economist who's anchored to very formal, very difficult models to run, my models tell me, no, we should be engaging in caution here around further rate cuts. And that's why Lori Logan at the Dallas Fed, that's why other Fed members are saying, hey guys, wait a second. We don't want to get out over our skis here.
All right, so no 50 or 100 basis point cuts. Everyone get ready now for a little market show and tell. And today we're going to be talking about risk in the bond market. In particular, there's something called the term premium, which is the extra yield on long-term government bonds, which compensates investors for the uncertainty of future interest rates. So maybe we can think of it as an uncertainty tax. Joe, so how do you see it, and what is the bond market uncertain about right now? And then maybe there's a lot to choose from.
For the past generation of capital market professionals who worked in fixed income, they got used to a negative term premium or a zero term premium.
Important point.
Yeah, and I have enough gray hair on my head and wrinkles on my face to tell you that's the exception, not the rule. So the term premium, which again is just the extra risk demanded to compensate for purchasing longer-term bonds, is rising. And it's going to continue to rise. And you can see it across the term spectrum. And for those of you who are interested in a little bit more sophisticated modeling, you can break it down and say, look at the term premium just between 10-year and 30-year. right? So that's going to be part and parcel of the narrative going forward. Why? The fiscal path of the United States is unsustainable. We've had an interest rate regime shift, which we've talked about on this show.
Sure, the regime change.
That's right, the
Earlier
regime
this year.
change. Yeah, we're higher for longer, right? And inflation, well, my sense is the market's already made a decision that the Fed's adopted a de facto 3% inflation target.
Interesting.
And so the market,
once again,
market and investors are moving on.
Will they ever admit that? We're moving our inflation target higher?
They won't admit it till the day that they engage in the formal review to lift the inflation target. But markets are not static, they're dynamic, they'll move on.
we got a minute to the break, and since we're kind of talking about markets here, you mentioned AI before the show and kind of the infrastructure trade. What do you think about what's going on with that now?
So I'm very, very bullish on AI. Now, that doesn't mean we're not going to have periods of irrational exuberance around this. You know, I like what I'm seeing. I mentioned my formal rules, my formal models. There's one platform I can actually ask it to do it. Now you have to instruct it as to what full employment is and what R star is, the real long-term neutral interest rate. But it comes up with a darn good estimate. You know, it used to be you'd have to pay somebody about $175,000 a year to run that research for you.
And now it's 20 or 200 a month.
That's right. It's quite
It's something.
stunning, and I'm very optimistic. This is going to result in a boost in productivity. It's going to lift the living standards of
holy
all
grail.
Americans over time. The initial distributions are going to be uneven, and it's going to accrue to those who know how to manage AI. Fortunately, I spent way too much time in college learning econometrics, which is the baseline of artificial intelligence. And we're hiring data scientists that report directly into me. So we're integrating this into what we do now. We're not waiting. And of course, if you're at a place like JP Morgan or Morgan Stanley or Goldman Sachs, their research labs are cutting edge in terms of how they're using AI to manage their portfolios and make investment decisions. So yeah, it's a really big thing. Now, does that mean the market's not overvalued? No. In fact, we have a model looking at equity markets that's one standard deviation above neutral, which tells me we're due for what I'd call a healthy correction. Kick the speculators and punters out.
All right.
Yeah.
Hold that thought. We need to take a short break, but coming up, we are talking Fed independence and a runway showdown featuring two different interpretations of a key Fed mandate. Stay tuned.
Welcome back to Stocks in Translation. This episode is brought to you by the number 14. That's the number of years a Fed governor serves. Those are the people who set monetary policy, deliver speeches, and share their economic projections every other meeting. 14 years is long enough to outlast politics and help protect policy from whiplash. It's one of those quiet design choices that keeps the Fed independent. And when that independence holds, markets tend to take the central bank's guidance more seriously. So, Joe, you've been writing a lot about this recently. Fed independence, you say, is one of the biggest surprises that we saw this year. Where does Fed independence sit today?
Fed independence is simply the sine qua non of asset and financial markets. Without Fed independence, we'd have much more volatility, larger losses, especially across fixed income space. You know, the Fed's instrumental independence, that is, the independent ability to set interest rates outside of a political context, is clearly the cohesive glue that holds this all together. The fact that the current administration is attempting to erode the independence of the Fed and browbeat it into sending the policy rate much lower than it should be, to get the Fed just to cut in such a way that it gooses the economy, but then creates very large risks over the near to medium term on inflation, should cause all capital markets professionals to take a step back and think about, hey, no matter how well my portfolio may perform over the next 2 quarters, no matter how big my paycheck gets, this is not in my long-term best interest or even my near-term best interest, right? This is why we had the great inflation from 1965 to 1985. Specifically, Lyndon Johnson and Richard Nixon browbeating the Fed into lowering rates or to sending rates into to much lower terrain than they ever should have been. And there will be real consequences for this. And that's why that term risk premium that we spoke of earlier is incredibly important. Because if you don't have independence, if the Fed policy rate and inflation expectations aren't well anchored, that term premium risk is going to go straight up.
And we saw that around the spring when there were concerns that the Fed was independent. Now that we've come off of that, yields are largely lower across the board. Is the bond market telling us that there's no worries there, that the Fed is truly independent at this point?
So we've got a bit of a disconnect in terms of our professional metrics. When we had the inflation shock during the pandemic, to be blunt out there, my professional metric of expectations, the 5-year forward break even, the 10-year forward break evens, they didn't perform very well at all. As a matter of fact, one could say they failed. Sometimes you have exogenous shocks, like the shutting down of global supply chains, and you get inflation, and the Fed couldn't do much about that, right? Okay, what I'm looking at now, and I think John Williams over at the New York Fed has also made a big case to capital market professionals that they ought to be looking closer at short-term expectations, specifically the New York Fed's 1-year and 5-year expectations, and even go back and take a look at University of Michigan, expectations. So what do I see? The New York Fed, which I think has the best metric, tells me that 1-year expectations have now moved to 3.2%. Okay, that's way above the 2% inflation target. My 5-year forward break even says 2.37. Okay, something's amiss here. Yeah, it may be that we're having a period of relative mispricing around where medium to long-term inflation's going in markets, and markets are underpricing those risks. Because the public is telling us something different, right? And so last time the public got this right, we on Wall Street got it wrong. Our professional metrics missed it. So this is a time of hubris, of humility.
And coming from a man who was just talking about econometrics and his history there. I appreciate that. I want to stick with the Fed discussion and long-term rates because when Stephen Myron was in front of Congress a few weeks ago, he raised some eyebrows when he quoted the third Fed mandate, kind of long forgotten, but the Federal Reserve for the last 20 years has talked about a dual mandate of stable prices, maximum employment, and has considered the third one of moderate long-term interest rates, which has been in there since the 1970s, to be kind of rolled up in the other two. What do you think about this?
Okay, what I think is that if you focus on price stability and maximum sustainable employment, if you can achieve price stability, you'll get maximum sustainable employment, and you will guarantee you obtain the third.
That's what Powell said
right?
when
That's
you were
right.
asked about that.
That's right, and that's what he should say because it is the case, right? The policy innovations around creating the federal funds rate and the other policy innovations they're talking about, perhaps replacing it, but it'll guarantee the third. Now, here's the problem. When Myron introduced the third mandate, it spooked Wall Street.
More uncertainty.
Because Myron's pushing for excessive rate cuts. That would almost guarantee that the Fed loses control at the long end, 10 to 30. And at that point, if you're a rational capital markets professional, you're like, wait a minute. You're going to push down the front end and let long-term rates go, mortgage rates go higher? Well, how do you fix that? Okay, wait a second. Are you talking mortgage-backed securities purchase? Are you talking an operation twist where you twist down the end of the curve via some unique asset buying and selling by the New York Fed? Are you talking QE? Are you talking yield curve control, yield curve management control? Right. The White House, the Council of Economic Advisors, and Mr. Myron, if you've noticed, have softly walked away from that. They've backpedaled. But, Jared, Allie, we're going to be talking about MBS, QE, Operation Twist, and yield curve control, I think, going forward. Because the logic of economic populism is you want to goose the economy no matter what, and you deal with those consequences down the road.
You heard it here first. We do need to get to today's runway showdown because it is a monetary policy fashion face-off that puts the Fed's mandate of stable prices in the crosshairs. On the left catwalk, in struts the 2% inflation target. Tailored, sharp, zero wiggle. It says price stability is always in style, and investors know exactly where the hemline falls. And on the right catwalk, in saunters the 1% to 3% range, flexible, weather-ready, built for supply shocks and surprises. It says, let the economy breathe without trying to panic him every little blip. Both look good under the spotlight. The point target can anchor expectations like a perfectly cut suit. The range can prevent overreacting to one-off rips and tears. Joe, who's wearing the best inflation target for the U.S. economy right now?
Not the Federal Reserve. We're too far away from target. And I mentioned earlier, many market participants are moving to a conclusion that the de facto target is 3%, and it's more appropriate for the current condition of the economy. If I take a step away and just where my economist hat exclusively, somebody who's not part of American business and capital markets, yeah, we probably ought to move to a 3% target.
Well, it's interesting you say current condition of the economy. Does that suggest that maybe the target moves more frequently than it has in the past?
I think that the last 15 years have been a period of severe adverse shocks. I think that the shutting down of the supply chains, the knowledge that we really didn't understand the inner workings of them properly, and the inflation shock that followed has resulted in that interest rate regime change. We now have inflation. Look at Japan. 30 years of deflation, they have inflation now. Something's changed. When you see these things occur, it makes sense that the institutions update their analytical and operating frameworks. I do think the Fed missed an opportunity to do that last year. I wish they would have. They didn't. Okay, it's water under the table. We're going to have to wait another 4.5 years for them to get to the next framework review. But again, I think there's a certain portion of the global investment community that's moved on, because if you look at long-term yields across the G7, with the exception of Germany, long-term yields are just moving much higher than they've been in a long, long time. Germany's the only one with any fiscal space out there, simply because I think that their debt to GDP ratio is sitting at about 65%.
We got to leave it there. Joe, lots of eye-opening stuff here. I mean, we started with your call for a potential reacceleration now, which I thought was quite interesting given where we are. We do have the Fed cutting right now. As you said, you believe the unofficial target is somewhere around 3%. And what can we say about the AI trade, except that it seems like there's a broad consensus that even though it might be a little bit overblown right now, it just has some long-term legs. And regarding that government shutdown, let's hope it doesn't last a few weeks, because then that just disrupts even more data that we're expecting to be disrupted this week. And we'll see if we get that jobs report on Friday. So we have officially wound things down here at Stocks in Translation, but be sure to check out our other episodes of our video podcast on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms.